Christian, great to have you on the program. Do you think equities are too expensive?
Well, thanks for being here and for inviting me. I think if you look at valuations, if you look at the next 12 months PE, for example, you indeed would see that if you look at the S&P, we are at levels seen last time in 2000, 2001 when we had the tech bubble. And probably somehow same is true for Europe, where you see also the PE ratios the next 12 months at quite high levels. I think we have to differentiate here between the US and Europe because one area, especially the US, is more growth. Europe can be considered more value, I would say. If you look at some indices like the German index, for example, which is clearly more value. I think, yes, if you look at valuations, equities are certainly not cheap here at this point in time. I think what we see from a market perspective is that the market moves is probably celebrating the reopening of the economies, that there's a lot of stimulus from the fiscal side, from the monetary side, and we will hear from ECB today. And we heard already Germany putting up another package this morning. However, I think down the road there will be some realization. It's probably not a V-shaped recovery, and from that perspective, I wouldn't be surprised if we see some setbacks, probably when it comes to the next months in markets.
Christian, I go back to John Arthur's piece because he writes beautifully, and he basically says, you know, like seemingly everything else in life, the reaction to the rally has really been polarized. Are market participants looking at different things? It's true that if you speak to 50 strategists, they say this is insane, and the other 50 say this is good. What does it actually mean in terms of how people analyze the markets?
Well, of course, there are different ways to analyze it, right? If you look at the recovery and you say, okay, there's a massive recession, and now there will be a V-shaped recovery or at least stronger growth because of all these measures, that could justify a higher PE levels, probably also due to very low interest rate levels we have now globally. And with that, you can certainly justify, as I said, higher PE levels. Nevertheless, I think the market is now pricing for kind of perfect V-shaped recovery, and I would be very surprised if we see that happening. Our view would rather be, you know, don't want to be too complicated here, but it's like a square root if you look at the mathematics. So first a massive drop, then a substantial recovery, but then the second level, and that's probably a bit different from the square root sign, is a bit lower. And I think once the market is realizing this one, because of, for example, unemployment to stay relatively high for quite some time, I don't think it's a V-shape and everyone will be into the jobs already this year, probably not even next year, to be very honest. I think then the market would realize that it probably was a bit too positive at this point in time.
Christian, when you look at European stocks, so where do you see value? European stocks are actually rising to a 3-month high, you know, as the economy start to reopen, and we tracked it in a great graphic, which we'll show in seconds. But do you break it down by sectors? Do you break it down by countries or regions?
Yeah, I think what would be probably a good approach here is, as I mentioned, to look at growth value. And what we have seen, especially massively over the last days, is rotation out of growth into value. Growth has outperformed value so much by such a distance over the recent weeks and months, and now we see some rotation. And looking into value, I would look at some stocks, for example, in the material space, where you see the recovery probably taking place. But you could also look in some parts of the financials, which have been doing quite nicely over the recent days as well. Just yesterday, we discussed in our forum that also to look at U.S. financials, including insurances, which would also be value stocks, could be interesting. So I think to build a portfolio like a barbell strategy, some value stocks with predictive cash flows is probably something which makes sense. Nevertheless, I would still say that what we have seen on growth on technology, this trend is still there, and I think what we see from the crisis here is this trend will probably continue. So from that perspective, a barbell could make sense, but I wouldn't say now you need to switch everything from growth into value. That's not our view.
Christian, we'll talk about this, you know, a little bit later, but just maybe to get what you think of the U.S.-China trade tensions and whether we could see a correction of that. We also heard overnight that the U.S. may relabel China a currency manipulator. Would that change where you put your money?
Well, first of all, I think we have seen quite an escalation between U.S.-China trade conflict. Really that's probably much more than we have discussed, where the market was really feeling some stress last year at the beginning of this year before this crisis came in. I'd really say this has escalated quite a lot. Probably has also to do with the election coming up in November. I would suspect that probably President Trump is really trying to push with China even closer to the election. So I would not be surprised if we see even more of that tension. On the other hand, I would say China is playing time and probably has more time than the U.S. president because no elections obviously in China. So I wouldn't be surprised if there's further escalation to this. And that could also be a driver for markets if they focus more on this one, not only of reopening of the economy, to cause a little bit more volatility here. So that would be, I think, a topic of the next months to come until at least the U.S. elections.